All right, hello and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James, and today we're going to be talking about Plug Power. Plug Power is a company that is one of the most questionable companies that we've examined on this channel before, and we've made videos on it in the past. So if you haven't seen those or are not familiar with Plug Power, we'll have those linked in the description below. But today we're going to be taking a look at some recent developments at Plug Power. So I'll just hand it over to you, James, to explain what has happened with Plug Power since our last update.
Yeah, so one thing real quick before we get into the video today, just a reminder about our website at differentiatedanalytics.com, which is a service we offer that gives a ton of premium investor resources to subscribers, including our original short selling research. And all of that can be accessed. You can sign up with a link in the description below. Premium members also get access to our Discord server where we talk about stocks, and you can also recommend video ideas. If you've already signed up but haven't received access to the Discord for whatever reason, please just email us. The email address will be also in the description below. With all of that being said, let's get into today's video topic, which is Plug Power. So, the last video we made about Plug Power was during the first quarter of 2024, I think around February. And around that time, it was obvious that Plug Power was about to run out of cash, and they would almost certainly need to do a dilutive equity raise just to get enough cash to keep the lights on. Well, then in February, while it was being widely expected that Plug Power would issue stock to raise cash, Plug Power's CEO Andrew Marsh gave an interview to Barron's where he said, "Everybody's thinking I'm going to issue common stock, but that's probably not necessarily what we're going to do," while noting short sellers may be in for something of a shock. So what the CEO is trying to say is, what appears what he was trying to say was, okay, well, all these short sellers who are shorting Plug Power stock, well, they're expecting us to issue a bunch of new shares, which will increase this share count, which will cause the stock price to go down. But that's probably not necessarily what they're going to do. So short sellers might be in for a surprise. So it was this really kind of weird elliptical thing that Andrew Marsh was saying, sort of hinting that maybe they won't do an equity raise. Well, then we got the a few months later, we got the 10Q financial reports, and it turns out that Plug Power indeed did an equity raise. During that quarter, they issued almost 80 million new shares, raising $300 million. And that's money that they really needed. Had they not raised that money, they would have run out of cash during the quarter. So despite whatever word games the CEO likes to play, Plug Power is a company that is losing a huge amount of money and is basically only surviving through the issuance of new shares. Now, one thing that happened recently, which is viewed as positive for the company, is on May 14th, the Department of Energy announced that they gave a conditional commitment for up to a $1.6 billion loan to Plug Power. And this is related to the Joe Biden's infrastructure bill, which gives a bunch of subsidies to green energy. And the department, while this loan is not, it hasn't technically been given yet, the fact that the Department of Energy gave a conditional commitment means that it's very likely that Plug Power will indeed get this loan. And this $1.6 billion loan is specifically for Plug Power to build 6 new hydrogen production facilities across the country to produce more green hydrogen. Now, if you watched our previous videos on Plug Power, we know that the real problem is that hydrogen is economically inefficient, and the only way that Plug Power has been able to operate its business and get any customers is by selling the hydrogen to customers at below cost. So just the fundamentals of hydrogen is that it costs a lot to produce. So therefore, for Plug Power to even sell it, they have to sell it at a loss. Because other forms of energy like diesel or natural gas are far more cost effective. So the only way to sell hydrogen is to sell it at a loss. Even after receiving this $1.6 billion loan from the Department of Energy, the fundamental economics of hydrogen have not changed. Plug Power is just getting this loan to expand their already money losing operations, which will probably just mean that, they will lose even more money. And another thing to consider is, some people might think, well, if the government is willing to give this loan to Plug Power, well, that means that the government thinks that Plug Power's business is actually legit and the hydrogen is legit. But just because the government lends money to something doesn't mean that it's legit. And one of the most famous examples of this is in 2009, the Obama administration gave a $500 million loan to a solar company called Solyndra. Within 2 years, so in 2011, Solyndra declared bankruptcy, and the government made a huge loss on the loan. And the point there is that just because the government backed some company doesn't mean that that company's going to be successful. The government isn't necessarily, the Department of Energy isn't necessarily the savviest of investors. Now, again, if you've seen our previous videos, the big recent claim that Plug Power was making was that, in the past, they would have to buy their hydrogen on the open market. And they claimed that was very expensive. And then, they would resell it to Plug Power would resell that hydrogen to their own customers at a lower price. Basically, it's Plug Power subsidizing their customers by selling the hydrogen below cost. Well, then, over the past year or so, Plug Power has been building uh, its own production facilities so it can internally produce green hydrogen. And they've made all types of claims in the past, saying that the green hydrogen that they're going to make internally is going to be 1/3 the cost of the gray hydrogen that they used to buy on the open market. Now, in our previous videos, we've delved into those claims and why we think they're complete BS, and that if anything, Plug Power's internally produced green hydrogen will probably be even more expensive than the gray hydrogen that they used to buy. But now, in the first quarter of 2024, so specifically on February 1st, 2024, their first green hydrogen production facility in Georgia, officially came online, and they started delivering their green hydrogen to customers. So if it were really true that Plug Power's green hydrogen was so much cheaper than the gray hydrogen that they used to buy, well, then you would expect to see some improvement in their gross margins, specifically for the hydrogen fuel sales. In the first quarter of 2024, which is the same quarter that they began delivering their internally produced green hydrogen, they made a gross profit of negative $40 million on hydrogen fuel. So they're still losing a huge amount of money. And as a percentage, the gross profit margin specifically for fuel was worse than negative 200%. So they're basically selling the fuel for about 1/3 of the cost to their own cost to produce it. In addition to, previously, as of the past, in recent months and over the past couple of quarters, Plug Power has really been coming up with two ideas that it's been telling to investors about how they're gonna right the ship and eventually get to profitability. The first was producing their own green hydrogen internally, which is what we just talked about. And the second initiative that they were going to do to increase their profitability was to increase the prices of basically all of the products that they sell to their customers. And they say, okay, well, we're basically selling not just the fuel, but they're selling pretty much everything that they sell. All of the hydrogen equipment that they sell it at below cost. And they say, okay, well, we'll start increasing the prices we charge to our customers, and that'll help us get to profitability. So that's what they started doing in the first quarter, and predictably, their revenue crashed. It fell by more than 40% compared to the prior year. That same, their revenue declined by more than 40% year over year, and this was a completely predictable result given the fact that um, the only reason that they were, really able to sell a lot of equipment and stuff to their customers, the only reason the customers were willing to buy it is because Plug Power was willing to um, price sell it at a price below their own cost. So the customers were willing to buy the equipment because Plug Power subsidized it. Well, now that Plug Power is no longer subsidizing it, or at least not subsidizing it nearly as much, predictably, customers are no longer wanting to buy the stuff. Therefore, the sales revenue has collapsed. This was completely predictable because the main problem with Plug Power is that hydrogen is economically unviable compared to traditional fuels like diesel and natural gas, etc. So therefore, the only way that Plug Power can get people to buy the hydrogen stuff is to price it at below cost. So therefore, there is really no path. They can try to play around with whatever pricing gimmicks they want, but the fundamentals of hydrogen are such that it's basically impossible to make a sustainable, profitable business out of it because the economics of it are so bad. The hydrogen is just too expensive. And then another thing they talk about with the cash burn is they like to talk about how they're decreasing their rate of burning of cash, and they specifically bragged about the fact that in the first quarter of 2024, Plug Power generated cash flows from operations of negative $168 million, and that is indeed a significant improvement above the negative $277 million of negative operating cash flow from the prior year. So they're saying like, okay, look, we're making some improvements while we're still losing money. Our rate of cash burn has decreased substantially compared to the prior year. However, there's one problem with that. If you look into the details, all of the improvement in cash burn is attributable to changes in working capital. So in the first quarter of 2024, there was a $29 million decrease in working capital. And if we compare that to the first quarter of 2023, there was a $146 million increase in working capital. So what does that mean? The working capital line items are down here. So in the first quarter of 2023, Plug Power purchased or generated an additional $131 million worth of inventory. So that when you build up inventory, that decreases your cash flow from operations, but does not impact the income statement because you're just building up inventory. But that impacts your working capital. Then in the first quarter of 2024, they also built up their inventory, but the inventory build was much less compared to the prior year. So having less inventory build improves the cash flow from operations. But the biggest impact here is the accounts receivable. So Plug Power's accounts receivable decreased by $96 million in the first quarter of 2024. So that was basically for products that they had already sold in the past, and now they're collecting the cash on that in the first quarter. So that serves to increase the cash flow from operations, but that has no impact on the income statement because that revenue had already been recognized in a previous period. So basically, what Plug Power has been trying to do is they've been trying to conserve cash by decreasing their working capital. And that's how they were able to get such a huge improvement in in cash flow from operations in the first quarter of 2024. But that will only last you so long, because if we take the example of the accounts receivable, okay, they have some amount of accounts receivable, they can collect on that over time, and then that'll improve their cash position. But if you keep doing that, eventually you run out of accounts receivable to collect on, right? So it's not possible to have a favorable impact from working capital indefinitely. Eventually things have to balance out. So reducing your working capital is just a one-time thing you can do to increase your cash flow, but it's not sustainably actually making the business more profitable. So excluding working capital, their cash burn actually got worse in Q1 of 2024. And it was actually $66 million worse. So it went from negative 131 million in Q1 of 2023 to negative 197 million in Q1 of 2024. So I know we got a bit into the weeds there about the working capital, but the point I'm trying to make here is that when you hear companies like Plug Power bragging about, oh, we've decreased our cash burn compared to the prior year, well, you have to actually go down and look and see, okay, is that actually sustainable? Because if you're just increasing your cash flows by reducing working capital, that's not a sustainable solution. And if we, actually look at the fundamentals of the business, things are actually getting worse, not better. After we adjust for the working capital changes. And so finally, given the cash burn situation, how much longer can Plug Power last? Now, as we talked about, excluding changes in working capital, Plug Power burned $197 million in cash flow from operations in the first quarter. They also had about $93 million of CapEx. So that's about $290 million of negative free cash flow. That's in the first quarter. So if we annualize that, multiply it by 4, that's about $1.15 billion of negative free cash flow per year, based on Plug Power's current market cap. As of the time of making this video, is about 2.6 billion. So Plug Power's run rate cash burn is about 40% of its market cap per year, which is a huge rate of cash burn. And given that almost certainly Plug Power is going to need to fund their losses by issuing common shares, we could see them, it wouldn't surprise me to see them increase their share count by 40% per year to fund this, $1 billion of cash burn per year. And, when a company is diluting its shareholders by 40% per year, well, that usually, that almost never ends well for the stock price. And then there's also the Department of Energy loan, the $1.6 billion. But $1.6 billion sounds like a lot of money, given Plug Power's massive rate of cash burn. That's only about a year and a half worth of cash burn at the current rate. And in fact, once they actually start getting this DOE money, Plug Power's cash burn is almost certainly going to accelerate because this DOE money is specifically to build 6 new hydrogen facilities across the country. And that will, they're going to have to spend that money to build these facilities, which will cause CapEx to increase. So they are going to get an infusion of cash from the Department of Energy, but because, that obliges them to build all these new facilities and expand their operations, their cash burn at the same time their rate of cash burn at the same time will also be increasing. So it's not really going to buy them that much more time, maybe a year or a year and a half. But, at the end of the day, the business is still unprofitable. The fundamentals of hydrogen just aren't there. Plug Power has been around for many, many years. And throughout all this time, they've never figured out how to be profitable. And that's just the nature of the industry. Hydrogen is not economically viable, and any business, any company that tries to build its business around hydrogen is almost certainly going to end up losing money, like Plug Power currently is.
So one question that I would have is, like, for Plug Power's customers, like the warehouse operators or whatever, why it seems like it should be obvious that this supply of artificially cheap hydrogen that Plug Power is providing is not sustainable. So like why would their customers buy hydrogen vehicles or forklifts or whatever they're buying, knowing that that their supply of hydrogen is unsustainable? Like, are they just doing it for like a experiment, for a headline, or what?
Well, they have. Well, to be fair, Plug Power has been around for a very long time. For many years. I think it was founded like all the way back in. I think it IPO'd all the way back in like 2000. But I think they only started selling the hydrogen forklifts maybe 10 years ago or so. And so even if their main customers are like Amazon and Walmart, they use the hydrogen forklifts in their warehouses. And then so from the perspective of Amazon or Walmart, okay, there's this Plug Power company is willing to subsidize the fuel cost. So it's, economically makes sense for the likes of Amazon and Walmart because they're, benefiting from this subsidization. Uh, and then they know that even if Plug Power is losing money, Plug Power has the ability to issue shares to raise dilutive, equity capital, which will allow Plug Power to last for at least a few more years to continue subsidizing the fuel for their customers. So the likes of Amazon and Walmart, they can see that, okay, I'll get at least a few years of subsidized fuel, which is a good deal for them. And then let's say Plug Power goes bankrupt. Well, so be it. It is what it is. Amazon and Walmart will just replace their forklifts with, natural gas powered or diesel powered forklifts, and just go back to how things were. They'll take a little bit of a loss on needing to junk their hydrogen forklifts, but it's not the end of the world for them. So, and given that Plug Power is willing to subsidize the hydrogen fuel, um, I think some of the customers are like, why not? Why not just take advantage of this the subsidization? Well, I think that wraps it up for everything we had to talk about Plug Power in today's video. As always, if you have any thoughts on the company or just in general, feel free to let us know in the comment section below. Also, remember, you can sign up to our website, differentiatedanalytics.com, where you'll get access. With a premium membership, you'll get access to a bunch of resources, including our original short selling research and access to our Discord community. And for a limited time, if you use the discount code WSM50 at checkout, you can lock in a 50% off discount. So with all that being said, I hope you all have a great day, and we'll see you on next week's video.